So this is weekly commentary 34. Now, from the previous week, right? Um, we had this candle, and what this candle done on the weekly was it rebalanced this fair value gap from this candle's high to this candle's low, and it started to push higher. Now, where is it pushing higher to? My eyes are on this buy side liquidity pool above this candle's high, and you see how we're pushing towards it. We didn't quite get there. We had quite a consolidated week, especially the Tuesday and the Wednesday was very consolidated. Thursday and Friday did have large swings, but there were swings up and down and then back into the range, and we're going to touch on that later on in the weekly commentary. Where do I see the candles printing to? I still see the candles printing to this candle's high, right? So if we just consider the last three candles, right? Forget anything before this black down close candle. You have a swing point made here, right? You have a swing point made here with the low inside of fair value gap. This is something that I look for intraday as well, right? When I see that swing point made inside of a fair value gap, my eye goes to the closest liquidity pool, which is this. This is what they're going to reach for, right? Now this candle didn't get there in one candle, and we don't anticipate that to happen within one candle. It can take, X amount of candles to run that buy side liquidity pool. So I'm still expecting the candles to print higher towards this liquidity pool, being buy side liquidity above this old high, right? Now, if we look at the US 10 year, right, I want to take your attention to the monthly chart for the US 10 year. So what we had was early on in the month, we opened, it's October, right? Now it's like the middle of October. Now, what can we see? Early on October, because it is currently, I believe it's exactly halfway through the month now. I think it's the 15th of October when I'm going to upload this, right? Or the 16th. Now, what happened in the month already? We opened, we traded lower, and now we're pushing upwards. So, with the time left on the table for the monthly candles close, where is the monthly candle likely to expand to till the end of the month, right? This is how I use the monthly candle. In a previous weekly commentary, I said to you guys is when it's come towards, you know, halfway through the month, so 2 weeks of trading inside of the month, pay attention to the monthly candle. Each time frame has its role. This is what I like to use the monthly candle for. I want to see where the monthly candle is going to expand towards the end of the month, right? Remember a few weekly commentaries ago, I said there is always the NFP at the start of the month, and that's usually manipulative. So we opened. This is probably the NFP week, and now we're pushing higher. Now, where are we pushing higher to? There is these highs that we've run. There's this buy side liquidity pool. You see these candles high and this candle's high. That's a relatively equal. Look, if we look at this candle's high, the candle's high is 4.279, and that's 4.285. Right? You see how they're relatively equal, right? That's where I want to see the bonds push up higher. Now, if you look on the US 30, it's pushing up higher above this high. Now, when we come to this high, I want to see a punch above, right? So you see how it's just at 4% right now. I want to see it punch a little bit above, preferably around 4.2, which is what I want to see, right? Now, what does that do for the DXY from, lesson 2 of the entire mentorship? Because there's a lot of new people that have joined recently. The relationship between the the bond yield and the dollar index is a positive relationship. We don't see them like the euro and the dollar. The euro, USD, and the dollar index, the DXY, they are candle for candle the same. DXY prints an up candle, euro USD will respectively print a down candle. You can match euro and DXY, they're complete inverses. If you put them on a chart overlaid, they're just complete inverses. Now, the relationship between the US 10 year and the DXY is positive, but it's not tit for tat the same. But we can use the US 10 year to see if the US 10 year is gonna likely punch above a liquidity pool, the DXY is probably gonna expand with it. Now, using that, we can then trade Euro USD against the DXY. This is how I like to frame it. Now, before we go more into the technical stuff, this well, last night I posted some macroeconomics for, my public Snapchat story, not just for you guys. Now, I wanted to touch on something just to reinforce the idea. We trade and we give a big respect to technical analysis, right? Even though we give that big respect to technical analysis, we have to submit to the fundamentals because the fundamentals, it this is what the high time frames reach towards. Early on in the year, the Fed, they wanted to begin the tapering process, right? Essentially, it's reducing the supply of money in the economy, right? Now, they also realize that inflation is spiraling out of control. Now, this is important to note, right? These things are important to note. When you see these things, I look straight towards the bond market. Now, I didn't tell the public about the bond market. I just told them about the dollar index. But we know what's moving the dollar index. It's the bond market. You need to know what's going on with the yields because that's respectively going to impact the interest rate. You remember FOMC last month, September? We saw the US 10-year, right? If you don't remember, on the US 10-year, we called this entire move in the mentorship. Now, you guys, you'll get to that weekly commentary. When price was here, we called this move into this mitigation block lower. Now, look at what? Look at the days, right? Look at the date. This is the 2nd of August, right? We moved here into the sell side liquidity pool. 1st of August, we hit that sell side liquidity pool, right? And this is a weekly fair value gap. Now we're pushing up higher, right? September starts. Now, what happens in September is there's an FOMC meeting where they're going to talk about the rates. This buy side liquidity pool, look at it. Just pay attention. These things are so rigged. And I'm showing you on the chart. August, the month before the big meeting where they're going to talk about increasing the rates, they ran sell side liquidity pool and they ran that fair value gap. Now it's coming up to September. It's coming up to the FOMC meeting. That's the 2nd week, right? What did they do? They have this high that they're working towards. This is the target that they're working towards, right? Come here, and this is the FOMC meeting, right? You see, look at the push above it, and it's all in line with the price action on the chart. This is how I was anticipating them to increase the rates, right? Now, I personally don't concede to the fact that they are done with the rates. I just don't concede to that. I believe they will increase the rates again. Especially in the UK, there is a significant problem, right? The UK economy and the US economy, they are very intertwined. That's why you'll see that that's why GBP and a dollar are very heavily inversed. GBP, euro, and dollar, they are very similar because it's because of their significance to each other's economy. They're so intertwined, right? We make up a lot of each other's currency and GDP. This is the reason why there is that correlation between GBP USD, Euro USD, and the DXY, right? You'll see that our inflation figures and the US inflation figures are usually the same or just a little bit, skewed. And that's because of the intertwinedness of the economies, right? Now that means when the dollar, gets hit, when America gets hit, we also feel that, that shockwave ripple through our economy. Now, people underestimate and they forget how much money they printed in COVID. I think the statistic was this. In that one year, I think it was 2020 or 2021, they printed 90% of all US dollars in that one year. 90% of the entire circulation was printed in that one year. What does that tell you? They have a serious issue at hand because there is this too many dollars. They need to reduce that, that circulation of dollars, right? The dollar essentially was way too cheap now. They need to find a way to make the dollar valuable. That's why you're going to see the DXY run levels. Now let's look at the 3-month. The 3-month chart. Again, candle opened, traded lower, and it's expanding. This buy side liquidity pool is on the table, right? Look at where the candles are expanding towards. Now, what does this tell you? There's going to have to be a reason to push price so significantly. The last reason to push the DXY into this 113 level, it was 114 before, was the FOMC meeting. November the 2nd, there is another FOMC meeting. That's going to be big for the end of the year. I've been reiterating a fact to you lot on the Telegram chat that by the end of the year, right, and I say to you guys, the end of November to January is usually a very dry period for the market. Now, I'll tell you this. I frame the runs on liquidity on the higher time frames with the quarter of the year and the month of the year. Likewise, right? Intraday, I know if there is no time aspect on my side, it is very unlikely to run a liquidity pool, right? Now, and I also know this, if New York, right, expands and runs the buy side liquidity pool, then I know that the rest of the day is going to consolidate. Why? Because the target, the objective is achieved. We ran buy side liquidity pool, assuming that we've already delivered sell side. There was a Judas swing that delivered sell side liquidity early on in the day, and then New York went to expand and deliver buy side liquidity pool. I know that the rest of the day is likely to consolidate. It's not going to have large swings. Now let's use that idea on a month of the year basis. November has that last meeting, right? The FOMC meeting, the 2nd of November. You can check it on your economic calendar. We can have a look actually together here, right? I need to, let me just do this. This one, this is the one, right? That's the day that I'm, gonna see if we run buy side liquidity. Because now, if that runs the buy side liquidity pool, what does that mean? What's after November? December and January. Those are holiday seasons. Now, if we run liquidity with that meeting, we are not anticipating much more high time frame liquidity pools to be delivered to because that run on liquidity for the year is done. Do you see how it's a fractal nature with the runs on liquidity? And then you're going to treat December and January like how you would do outside of a kill zone time. This is true time and price. Now, new people listening to this may not make any sense, but this is the 34th weekly commentary. You need to watch every single video in the structure I have uploaded. When you come to this, what I've told you right now is gold, because this is essentially giving you the framework of your trading for the year. Treat the, December and the January like how you would with after kill zone hours, right? It's like this, for example. 6 p.m. in UK time, are we expecting a delivery on Euro USD's liquidity? No, because it's way outside of the kill zones, and the kill zones, assuming that they already deliver liquidity, 6 p.m. outside of 3 p.m. UK time, or you could extend it to 5 p.m. London close kill zone. We're not expecting that liquidity delivery. That's the same thing with the end of November, December, and January. They're outside of the quote unquote quarter kill zone for the liquidity delivery. Those are more of accumulative periods in the year. So that's what I'm framing these higher time frame runs on, right? So we have the monthly one here, and potentially, I just want to see us get up to here. This is what I'm seeing us to get up to. Now, come December, and we're not there yet. Maybe December early on we can run it and then accumulate. That's what I'm anticipating. But let's go back into the chart. So for the DXY, I'm anticipating this run on buy side liquidity, right? 3 bar pattern, swing point made inside the fair value gap. I'm expecting the expansion to be upwards higher, and that narrative is backed with the US 10-year pushing up higher, right? Now, respectively on the euro, what do we see? A swing high pattern be made. This is an order block, right? Why is this an order block? Up close candle, displacement away. That's an order block, and we're moving away now, right? So where is the likely drawn liquidity to be? On euro, we've hit most of the sell side liquidity pools, but we're just going to use the previous candles low now. You see on the weekly and the monthly, even daily for an intraday, your liquidity pool that you can target is always the previous candle's low if you're selling, and the previous candle's high if you're, a buyer. That's what you can use to frame your sell side and buy side liquidity pools. So this candle's previous month's low, we want to see us trade back into it, right? We've moved up. There is no fair value gap in here. We want to see us push down. Pound is similar, right? Push down lower. With the Euro GBP, we've seen this, right? I had this fair value gap marked out. Now this wick, it went and it ran many candles highs, and you see how we came down. And now this candle opened, and it's moving down lower. So what does that show? It's showing us that we're gonna have a relatively weaker euro. So the shorts on Euro USD are gonna be the more explosive ones. And I'm sure Euro USD this week, if I'm not mistaken, it has the news drivers. There is not a lot of news coming up this week. I have to go back 1 week. No, it's the next week. We have on Monday we have the red folder, and on Thursday we have the red folder. So that's what you're going to use for your weekly profiling. Make sure you have those weekly drivers on your notepad, right? And we're going to touch more on news drivers in the end of this weekly commentary when I go through the 1 minute open, high, low, close that we went through on Friday live on the Telegram chat. Now, if we go to the 4 hour chart, early on in this week, right, on the DXY, this was the Monday, right? This was Tuesday. We saw that Monday traded higher and it left what? A fair value gap. Now, whenever you see a fair value gap, outline it because when from the last weekly commentary, what did we say? We said that when this swing point is made, that initial retracement in the discount, we move higher. Where is the retracement that we're framing? Inside of fair value gaps. So when you see that fair value gap get left, we want to outline it. Now look at the candles respecting it, right? It bounced 1, 2, 3 times inside of it. Now this was the framework I used for a market maker sell model on the DXY on a Tuesday, and the market maker buy model on the Euro. Um, I think it was around the end of the New York kill zone, right? If we go on a 1 hour chart and we start delineating the Friday, Thursday, Wednesday. Sorry if I'm clearing my throat because I just have a quite sore throat. Tuesday, Monday. Okay, so you see this, right? This move down into the fair value gap. Let's look at that on the 5 minute chart because I get asked about the market maker models quite often, and this is the best way that I can touch on it for you guys, right? Now, what do we see here, right? We see this market maker sell model. Now, what are we anticipating? We have that fair value gap, right? We have that fair value gap, and we want to see the move down into it before we start moving higher. So what do? We sit on our hands until we see the willingness to go and offer it, right? Now, what do we have here, right? You see here, you see this run on this run on this high, right? And that displacement lower. GC, that's what you're looking for. Now, when I see that, I'm thinking of retracement. Now, when you see the retracement intraday, when you see a retracement and it's in the form of a buy model, the buy curve or the buy side of the curve, sorry, for the market maker sell model. Because before you sell on the market maker sell model, there is a buy side of the curve. When I see this, right, some people have to call it the three-leg drive pattern. You know, when you go up, come down, and up, come down, three drives. Something like this if I use my path tool. One leg, two leg, three leg. And that's called a three-leg drive pattern, right? When you see something like that, and it's delivering you into a premium, your mind should shift to possible market maker sell model. Make a note of that, right? Now, you can also see a clear trend line being formed. That's another way I taught the market maker models in one of the weekly commentaries. Now, when I see this, right, this array, now you see right here, inside of this fair value gap, we trade into it and the candle comes down lower. This candle immediately engulfs it, right? And then what do we see? We see the come up, and now we're seeing this candle get respected as a bearish order block. And what happens again? This candle comes down. Are you seeing the displacement? One displacement, two displacement. In my head now, it is a market maker sell model, right? And where am I looking to target? This fair value gap, right? Because that's our daily level. I'm not looking to deliver to this 5 minute low. I'm looking to deliver to this daily level because that's what price is reaching for. It's reaching for those daily high time frame levels. Now, that, right, when you see that in the narrative, if we look at euro, let's go back here for a sec, just to get the date. I know it was at 10, I remember. The 11th of October. This was the respective buy model here, right? Now on euro, what do we see, right? This low was swept. This is a rejection block, right? Now, the rejection block that I taught you guys in chapter 2, what do we like to see the rejection block do? We like to see it sweep a level. You see when it sweeps the level and comes back up, this is the rejection block, right? Now, what do we have? This, if I mark this out, this is the initial consolidation that your ally is targeting. But remember, you're framing the run on euro with the run with DXY into its fair value gap. So once euro is here and DXY is not inside of its daily fair value gap, you know euro is still going to expand higher until DXY touches its fair value gap. When DXY reaches its target, you take profit on the euro. This is how you trade the euro USD and GBP USD, right? Now, what do we have here? We have the initial consolidation. You see us coming up, down, come up, down. Now, what happens here? That's a market structure shift. High, low, higher, high, right? That's a market structure shift. Now, what is your mind going to? And you know you're in a market maker model. You are looking for the retracements down, right? You're looking for the retracements down. Now, what do you have to work in here? This is what you look at straight. When there's a market structure shift, what array is there for me to work on? Usually, I love to see a fair value gap here. And a lot of times, more times than not, you'll see a fair value gap here, right? There was no fair value gap. These two down close candles to make an order block. And you see here. Now, let's talk about open, high, low, close once we do this. We tag into that order block and we move up higher. You see this candle? It's keeping that open, high, low, close intact. Now the candle's expanding, right? Now we have a fair value gap from this candle to this candle. So we know we can expect the candles to print down lower into the fair value gap. And then we expand, right? Now look at the open, high, low, close of the candles here. Only when there's an imbalance, the lows of the candles get taken. When it's filled and the next candle, right, look, pay attention here. You see how there's a fair value gap from this candle to this candle. You see this candle, it comes in, it doesn't full close it, comes to the consequent encroachment to 50% of it. And it makes that swing point. Remember, on the DXY weekly, this is what I showed you. Swing point inside of a fair value gap. And you want to see the candles expand towards liquidity. That is a fractal pattern that you can look for in every time frame. That's how you trade the market maker buy and sell model. You look for the DXY first, not the euro. You look at the DXY first. Then you're looking to match it on the euro. Your profit taking is being matched with DXY targets on the euro, right? Match the times here. That's 1240. Match the times here, right? Let me just zoom in because it's very zoomed out. and it's 1240 as well. You're matching the times it's running into it with the higher time frame area fair value gap, right? You're going to use that for your profit taking on the euro as well, right? That's just something I want to go over. Remember, for the market maker models, you need to identify the initial consolidation before you're seeing the opposing side of the curve made. Opposing side of the curve made means if you're anticipating market maker sell model, remember it needs to start with initial consolidation and then the buy side of the curve, higher time frame premium, sell side of the curve, right? That's what you guys need to be familiar with. A lot of you guys trade the S&P, so let's touch on the S&P. And now it's the same thing. You're going to see it again here, right? Fair value gap, right? From this candle to this candle. What's made inside of it? A swing point is made inside of it. Now, this candle, this week, we didn't exceed that candle's high. Open, high, low, close. That candle went for the imbalance and it came down. Now, I expect the candles to print lower. I don't think that this is, people online are saying this is going to be the reversal for the stock market. You guys need to realize that a reversal needs to be funded by a macro driver. There is no reason for the stock market to stop continuing down. As inflation is still going to increase, as interest rates are still on the table to increase, there is no reason for the stock market to increase in its value. Interest rates and inflation have a complete inverse relationship with the stock market, right? Inflation and interest rates go up, the stock market goes down, right? I want to see us, trade down lower. I want to see the next candles print down lower for the S&P, right? A lot of guys are talking about crypto. I'm really not fond of it right now. Look at the weekly ranges for the candles. Do you see how small they are? It's just in a very accumulative phase. I feel like November is going to be held in consolidation until that last FOMC event in November the 2nd. I think this is what it's, really held up for. That November the 2nd, have that marked down your calendar days, right? Now, before we end this weekly commentary, you guys wanted to go over. I just remove this. Let's go over Friday's price action. This is the sweep on the level that I was working with. On the 15-minute, right, now let's talk about it. Asian range, right, that I teach you guys. From 8, let's just mark it out. Doesn't hurt to do it. Now, what did the Asian range do? Is it consolidating? No, it expanded. Now, when you see the Asian range take liquidity, right, you're not really anticipating the run on Asian highs again, right? In this case, you can frame OTE to get close to the Asian range high because it ran liquidity, right? When you see that run on liquidity, get OTE from it, essentially, right? Now, when we come down, right, you see this high to this high. Let me just make this not dotted. You see from here to here, these are equal highs, right? Retail see this as what? A double top. Now, this is what I had marked out, right? When I saw this, every single time there is an intraday equal high, right? That's it needs to be in my narrative. So I'm looking to short euro. I'm looking to short on euro. So every single time I see a suspect buy side liquidity pool, I am going to outline that. 5-minute equal highs, I'm outlining that. Why? Because I'm going to use that for my shorts now. Remember, we need that buy stop liquidity to frame our sell, our short position against them. Now we run up here. Now this is when I'm watching the 1 minute because there was a 50-minute run on the level. You see when we go up here, right? When we go up here, we come down. When we come down, and I see this candle, and I see that this candle is not, it's not followed by an expansionary move higher, right? Now, a lot of people would treat this as an order block. That is not what you're treating as an order block. That is a breaker block. Now you see how it comes back into here. Note that this, right? Smart money concept traders on YouTube, they have no idea what they're doing. Please just understand what I mean by this. They say that a breaker is a failed order block. That is not true. How can you tell that this is going to be a breaker, a bearish breaker instead of a bullish order block? Look at the narrative. This is the last retracement before the run on buy stops. When you see that, you are not treating that like an order block. Look at your narrative. You are looking to be short on the euro. Okay, that's number one. You're looking to short on the euro. So automatically you should not be entertaining bullish price arrays. When you see you're bearish on euro and euro is the order flow on the higher time frame is clearly bearish. When you see that down close candles and then move up higher and it sweeps a level, this is the key. This level sweep is the key. This is what makes all of this make sense. That sweep on that level, you're now thinking when I come back down here, this is a breaker. Now, a lot of people that I know, some people, not a lot of people, what they do with the breaker, and it makes complete sense, they'll place a sell stop beneath this candle, knowing full well when they're strongly convicted that this is probably going to be a breaker. And then when price pushes past it, they're entered in. That's smart money stops, not your retail stops, right? Now, when I saw this up close candle and we're moving down, this is the order block. This is your order block. You see, when we saw this candle, a fair value gap run into here, that is a perfect entry on any chart. Up close candle, you swept the level, now you're displacing away. What you're waiting for is the up close candles. When you're waiting for the up close candles and you're seeing now it's gonna retrace down lower, you're using that as an order block. And it comes down lower. Now, where are we taking profit? Beneath the lows. You're not anticipating that reversal, more retracement, until that run on stops. Why? Because there's also self stops beneath here. Smart money longs to, cover their open shorts. It gets paired underneath these lows. Now what happens? Look, outline this breaker. This could have been the re-entry, but I wouldn't have taken it due to the time of the day, right? Comes back into the breaker block and it moves down lower. Now, when that sweep on the level happens, I'm expecting the open, high, low, and close to stay intact. Now, let's look at this on a 2-minute chart, right? Because when I see all these down candles, I want to sieve it down to a clear fair value gap, right? So we see here, this is what? This is the fair value gap, right? This candle and this candle. Now we come into it and we retrace. And we're anticipating every single, retracement to fair value gap until what? Until our sell side liquidity pool is hit. You see from here, and this is what I've tried to explain to you guys for very long. Please make a note of it. The time and distance, you can say this as like a formula. The time and the distance between your run on your opposing liquidity pool to the intended liquidity pool you're trading towards is opportunity. For example, we had equal highs here. From that run to the equal highs and the displacement away until this sell side liquidity pool on the 1 hour chart, by the way, this is a low on the 1 hour chart. Everything in from here to here, all the retracements is your opportunity to get in line with price, right? Now, the open, high, low, close, of course, is gonna apply to the 1 minute time frame as well and the 5 minute. I don't want you guys to go in and do it on the 1 minute like I done it. I done that, not as a flex on you guys, but to show you guys that this stuff works. If not all of you were on the Telegram chat when it happened, but this entire move from here to here was called. Now this was 10 a.m. And what was at 10 a.m. on the Friday? Check your Forex Factory calendars. It was a news driver. And what is the narrative? Before the news driver, we've already run buy stops and now we're coming down. What is the news driver going to be used to get? Take a wild guess. Sell side liquidity. This is how you guys have to start framing it. Your liquidity pools. You are looking for those runs on your liquidity pools. Intraday levels, right? Look for those equal highs on an intraday level. Those will get tagged. Do not look for your 1 minute equals. I say look for 15 and 5 minute liquidity pools intraday level. And you can use that to frame small scalps throughout the day like this on the 1 minute, right? When you sweep that level and you displace, you're expecting the open high low close of the candles to stay intact. Now, when the candles show a willingness to go up higher, your mind needs to shift to where's the fair value gap? Where is the array that it's gonna reach for? We see here, okay, cool. Now you see this candle. What do you think is gonna happen after you trade into this fair value gap and this candle comes down like this and it completely engulfs this candle? That becomes what? That's a change in state of price delivery. Now what do you expect? When there is a change in the state of price delivery, you're expecting the open high low closes to stay intact. Now look at the open high low closes of here, staying intact. What is there again here? From this candle to this candle, fair value gap. Retraces up. That high is intact now. Intact, intact. You're out here. That low, you're out. That's intraday high level scalping. I don't expect you guys, and you shouldn't expect yourselves to be on this level yet. Practice it on your 15-minute chart. Look at this. Look at your runs on 1 hour and 4 hour levels. Find a liquidity pool that was run, turtle souped, like this, right? The run on this was a 15-minute chart. Look at that run on the 15 and 5 minute equal highs. On a 4 hour chart, look for it. And then use your 15-minute candles after that sweep and see how they trade towards the liquidity pools given its time of day, right? Now, 10 a.m. is what? 10 a.m. is the end of the the New York Open kill zone, right? That's why you're matching that time of day with that run on sell side liquidity. Do you see how that was the run on sell side liquidity? And the news events are always in line with that. Now, the news events, one thing that I'm gonna bring a lot of light on when I type or finish that Word document for you guys. 8:30. Most of the news events for the USD is at 8:30, and that is not by chance. There is something very specific that happens at 8:30. I've taught you guys in the weekly commentary the importance of that 8:30 retracement. 8:30 in New York, you're hunting, right, from the start of the kill zone to 8:30, you're hunting a run on a level like this. You'll hunt from 7 to 8:30, a run on the level, and then you're expecting from 8:30 to 10 to expand. That's a very big hint. That's very, very big. That's what you're trying to hunt for inside of the New York session. That's what I only hunt for in the New York session. Either a run on the level or a retracement into an array if London already ran liquidity, right? So that's going to be the end of the weekly commentary. There was actually a lot of talking. Let's quickly touch on the daily time frame for these charts. Now we have this fair value gap that I have marked out mentally, but let me mark out for you guys. Let's remove these. If Monday shows the willingness to go higher, you're anticipating the run on these highs into this fair value gap. And then I want to see the rejection and go lower. If we find the rejection in here to go lower, I'm expecting the next candles to print lower, and this is a sell side liquidity pool. There has already been a sweep on this previous day's high, right? And the DXY, it's very messy, is also very similar. We're still inside of that fair value gap, right? We can move up higher. I still want to see the daily candles, right? You see how the daily candles we traded into that fair value gap and now we're moving away. I want to see us still carry on that move upwards to that buy side liquidity pool, right? Now, is there any other? Nope. So that's going to be end of this weekly commentary. For the new people, I know what I said a lot in this commentary may not make any sense, but you need to go through the content as it's structured. Don't skip a video. Everything is structured for your learning. It's the way that I intended it for it to be. This is the way that it should be taught. I know as a new trader, you just want to hear models and how do I enter and exit. That stuff is irrelevant if you don't know how price is delivering. I promise you, take it from me, right? You need to learn specific things and then you'll see the entry is very easy. I cannot teach you the entries. You won't even be able to make sense of the entries and exits. You'll be blindly doing it because you're going to be believing in a model. You're not going to be focusing on where price is trying to draw to. The name of the game in trading is this. Where are the higher time frames likely to go? Where are they looking to reprice? Now, what do I mean by reprice? Weekly fair value gap moved away. When we move away, where are we likely to reprice? Above this buy side liquidity pool. Simple. What do we do intraday? We take trades in line with that bias. That's it. But being able to read it like that, and we've read all these weekly commentaries, by the way, all these from like here. This is where the first weekly commentaries were. I believe this was the first weekly commentary, and we were bullish and we're calling retracements lower, and then we're moving up higher. This I remember we had to struggle a bit because of this candle threw us off. Right, this swept this candle's high. We want to see retracement, and then on this weekly commentary we got it, and then we're calling these moves as well. Because it's about knowing when the retracement is likely to occur and then when the expansionary repricing happens, and then you trade in line with it. That's it, right? So, like always, if you have questions, ask me on Snapchat. And until next time, I'll catch you guys in the next one.